Welcome to our Money Back Life Insurance Strategy Deep Dive. We're going to talk about how we protect your family with life insurance and how you can get your money back if you survive the policy. But not only how you get your money back, but also how you can make a profit in the process. You probably worked hard for your money, and we want to make sure that your money works hard for you. And we'll explain exactly how we do that here. The way we achieve all this is through our proprietary equity growth insurance strategy. The fundamental way this works is that as you invest in the policy, life insurance is put in place to financially protect your family. Simultaneously, the money is also being invested in the financial markets, and this builds a substantial cash value within your policy over time. Towards the end of your coverage period, you can stop the life insurance and put this cash value back in your pocket, which would amount to more than what you invested in the first place. And I'll go over some of the numbers to illustrate this. Now, let's talk about how all this works. This chart that you see here is what is referred to as an index chart. You may have seen this at the wall in the bank or perhaps at your financial advisor's office. And this chart basically gives us a good picture of how different financial markets have performed over the last century. Just be aware that the scale is a little different here. It starts out at $1,000, then goes to $10,000, to $100,000, and finally to $1 million. Now, overall, we see the trends of the market going up over the long term. In fact, if we take a popular stock market index, namely the S&P 500, we see that it grows on average by 10% per year over the long term. Now, the 10% is an average rate of return. Some years it's higher, some years it's lower, and others it's negative. Okay, now this all sounds good, but how do the numbers really work? Well, let's take a look at Alice. She's 35 years old and doesn't smoke, and she wanted a $250,000 coverage for 30 years. At the end of the coverage period, if the market only performed at 6% on average, then the expected money back would be around $36,000. Now, this would mean that for every dollar that Alice would have invested into the policy, $1.53 would be returned. Now, if the market is performing at an average rate of 8% growth, the expected money back would be around $56,000, which means each dollar Alice puts in to the policy, it would yield back $2.40 approximately. And finally, if the market performs at 10%, as it has been for the last century on average, then the money back would be roughly $87,000. Now, this means that in addition to providing $250,000 of life insurance coverage for 30 years, for every dollar being invested in the policy, there would be $3.72 return. Now, finally, if Alice doesn't cash out her policy and leaves it in place without paying any more premiums, the coverage in her policy would be projected to grow to over $1.3 million by the time she reaches 95 years old. For all this benefit that I've described, the monthly investment required by Alice would only be a modest $60 per month. Now, I know what you must be thinking. If this is all dependent on the stock market, and we all know that they go down from time to time, how is this going to work? Well, let's talk about this and how we deal with this situation. If we start off by looking at March of 2020, the market took a severe dip. By the end of the summer, though, most market indices had recovered. And this is known as a V-shaped recovery because the markets recovered almost as fast as they dipped. Now, this is an unusually fast recovery though. Typical recoveries can take a little longer. If we look at 2000-2001 tech bubble crash and the 2008-2009 financial crisis, it took about 1 to 4 years for most of the market indexes to recover. However, it's important to remember that dips are just part of the long-term growth behavior of the markets. Now, that being said, we still need to address the risk of this volatility. To solve this, we employ our double P method. The first P is prudence. Although the lifetime average of the stock market is about 10% annual growth, when we design your life insurance policy, we only assume that the market will produce an average rate of growth of 6% over the policy's lifetime. Now, we don't mean here that your policy will just scrimp or limp along if the markets deliver an average 6% rate of growth. We mean that actually your policy will actually thrive if the markets perform at 6%. Now, if the markets perform higher, then you'll just get more money in coming back into your pocket. The next P is patience. We spent time earlier talking about the historical behavior of the markets when dips occur. Now, if you recall that it takes anywhere between 1 to 4 years to recover from dips. So let's suppose that you sign on to a 25-year policy, and in the 24th year the market takes a dip. Well, you're not forced to stop the policy at the 25-year mark. You can just leave it in place for an extra few months or years to let the market recover, and then cash it out. Generally, it's always a good idea to sell high, and this policy gives you the flexibility to do just that. In fact, beyond the 25-year mark, you shouldn't need to pay any more premiums either. Okay, sounds reasonable so far, but is there a catch? Well, I like to answer this question with a question. Can your money grow and work hard for you without commitment? In other words, can it grow if you keep pulling it out all the time? Your money can only grow if it remains invested. And we want to see our clients, we want to see you be successful with this solution. So we'll only work with people that can make a solid 8-year commitment to this plan. That's our catch, and we stand by this one. Now, let's take a look at Matthew and his policy. He's 36 years old and doesn't smoke. He wants $250,000 of coverage for 30 years. And at the end of the coverage period, if the market only performed at 6% on average, then the expected money back would be around $46,500. Now, this would mean that for every dollar invested, $1.52 would be returned. At an average of 8% market growth, the expected money back would be around $72,500, which means for each dollar you put into the policy, it would yield back $2.37. And finally, if the market performs at 10%, as it has for the last century, then the money back would be approximately $112,500. This means that in addition to providing $250,000 of life insurance coverage for 30 years, for every dollar being invested in the policy, there would be $3.68 returned. Finally, if Matthew doesn't cash out his policy and leaves it in place without paying any more premiums, the coverage amount in his policy would be projected to grow to nearly $1.7 million by the time he reaches 95 years of age. For all this benefit, the monthly investment required for Matthew would only be a modest $85 per month. Now, let's talk a little bit more about flexibility, because it actually swings both ways. And let's take Lizzie. She started a 25-year, $500,000 policy, and 21 years into her policy, her mortgage is paid off, and the kids are grown up, and her cash value is exceeding the expectation. Lizzie gives us a call and explains that she doesn't need insurance anymore, and asks whether she can cash it out now. Our answer is absolutely yes. The decision is hers, and she gets a cash out value of about $43,000 to boot. Now, with money back life insurance, you are in the driver's seat. Now, this type of life insurance solution is very popular for many Canadians. But what's the keys to success here? As you might have guessed, this isn't just a simple term policy that your average broker draws up the paperwork for. The key to succeeding with this policy is having the right specialist in your corner. And this means having 3 areas of expertise. Number 1, since this solution requires market investments, you need expertise in investing. In our wealth management division, we manage multi-million-dollar portfolios. Next, it's important to track whether your policy is heading in the right direction. And we perform annual reviews with our money-back life insurance clients, as we do with our wealth management clients, so that you can be informed as to how well your money is working for you. And lastly, we have very specialized expertise in universal life, policies that enables us to minimize the overall cost of the policy to a fraction of the typical lifetime cost. And I'm going to elaborate on this, on how we do this, towards the end of this video. So stick around. Now, let's take a look at John. He took out a policy, and he's 32 years old and doesn't smoke. He wanted a $250,000 coverage for 30 years. And at the end of the coverage period, if the market's only performed at 6% on average, then the expected money back would be about $44,000. And this would mean that for every dollar invested into the policy, $1.62 would be returned. At an average of 8% market growth, the expected money back would be around $66,000, which means that for each dollar you put into the policy, it would yield back $2.46. And finally, if the market performs at 10%, as it has for the last century or so, then the money back would be just over $100,000. And this means that in addition to providing $250,000 of life insurance coverage for 30 years, for every dollar that John invests in his policy, there would be $3.73 returned. Now, finally, if John doesn't cash out his policy and leaves it in place without paying premiums anymore after the 30-year mark, the coverage amount in his policy would be projected to grow to nearly $2.4 million by the time he reaches 95 years of age. For all this benefit, the monthly investment required would only be a modest $75 per month. Okay, now here's a chart on how money-back life insurance can work throughout your lifetime. Kind of gives you that visual. Now here we have Phil, a 31-year-old male, with $1 million policy for 30 years. For the first 30 years or so, the policy is in what we like to call protect your family mode. And that's the role of traditional life insurance, is to protect your family. Now at the end of the 30 years, he can decide to cash it out for just under $275,000. Or instead of cashing out the policy, he could keep it in place and have it go into a build your legacy mode, which can build up a very significant inheritance for Phil's family late in life. Oh, and Phil should not have to pay any premiums after the 30-year mark. Now, I mentioned earlier that we have the expertise to minimize the overall cost of the policy. Now, take a look here, and you may have noticed a dip following the end of the 30-year mark. And we like to say that this dip is our differentiator. The most common challenge with life insurance policies is the high cost of insurance late in life, particularly in your 70s, 80s, and 90s. Now, here's the funny thing. Do you need the same amount of life insurance late in life as you do in your 30s, 40s, and 50s while you're paying a mortgage and raising a family? No, not likely, right? So here's what we do. We gradually reduce the quantity of life insurance that is purchased late in life. And as a result, the cash value can grow much faster. Not because there's a greater rate of return in the market, but because the cost of insurance is dramatically reduced. And this results in a $1 million insurance policy turning into a $5 million policy by the time that Phil reaches 95 years of age, assuming that the markets only deliver an average 8% rate of return. Now, what's next? If you'd like to move forward, the next step is very simple, is to get a quick quote done that fits your needs. We have two general approaches when it comes to building a quick quote. First, we can build a quote that is coverage-based. If you have a particular life insurance coverage amount in mind, like for example $475,000 or $700,000, we can build a quote based on that. On the flip side, we can also build a quote that is budget-based. So if you have a particular budget amount that you would like invested towards a money-back life insurance policy, like $200 or $95 per month, then we can craft a plan that gives you the best coverage and growth opportunity to fit your budget. Now, to get started with your quick quote, just scroll down a bit and answer a few simple questions to get the process started. And remember, it's your money and your family. Get started